welcome back to Prime Wealth. I'm Jordan.
And I'm Alex. We're excited to have you join us today.
Yeah, today we're diving into a really interesting topic. Index funds versus ETFs. It's something that a lot of people over 40 are starting to think about, right?
Absolutely. It's a big one. You know, both options can be great for building long-term wealth, but they have some key differences that we'll explore.
Right. So if you've ever wondered which one might be better for your investment strategy, you're in the right place.
Yeah, and we'll break it down like what each of them actually is, the pros and cons, and how they fit into your overall financial plan.
Exactly. Plus, we'll share some tips on how to decide which one might work best for you, depending on your goals and, your comfort level with investing.
And we'll also talk about some common misconceptions so you can feel more confident in your choices.
Yes, that's so important. So whether you're just starting out or looking to refine your strategy, stick around. We've got some valuable insights coming your way.
All right, let's get into it.
Here we go. So first up, let's talk about what index funds really are. So Alex, today we're diving into something that's really been buzzing in the finance world lately. Index funds versus ETFs.
Yeah, it's a hot topic right now. And it's especially important for folks over 40, because at this stage of life...
Right, you're thinking about retirement, right?
Exactly. People are starting to think about how to make their money work for them. And with the current economic climate, it's crucial to understand these investment options.
Yeah, I've seen some statistics that say folks over 40 are often looking for more stable, reliable ways to grow their wealth.
Absolutely. And, it's not just about growing wealth, it's also about preserving it.
Right, like we've been through some ups and downs in the market lately.
For sure. Just think about the last couple of years with the pandemic, inflation rates skyrocketing. And now interest rates are fluctuating.
It can feel overwhelming.
It really can. And that's why understanding the difference between index funds and ETFs is so important right now.
I know some people might think, oh, it's just investing. What's the big deal? But it's more than that.
Exactly. It's about building a foundation for your future.
And if you're over 40, you might be in your peak earning years. But you also might have kids in college or, caring for aging parents.
Yes. Life gets complicated, and you want to make sure every dollar is working hard for you.
So what's the big difference between index funds and ETFs?
Well, to put it simply, index funds are mutual funds that track a specific index, like the S&P 500. They're typically purchased at the end of the trading day.
Right, and ETFs are traded on the stock exchange, just like individual stocks, so you can buy and sell throughout the day.
Exactly. And that difference can have a big impact on your investment strategy, especially for someone over 40 who might be looking for liquidity.
Yeah, I remember a friend of mine who's in her 50s. She was worried about needing cash for unexpected expenses.
That's a real concern. With ETFs, she could sell shares quickly if she needed to.
Right, like if her car breaks down or, if she needs a sudden home repair.
Exactly. And that flexibility is something that many people in their 40s and 50s really appreciate.
So what about fees? I know that's a big consideration for a lot of folks.
Oh, definitely. Generally speaking, index funds have lower expense ratios compared to actively managed funds.
But ETFs usually have low fees too, right?
Yes, they do. But you've got to watch out for trading fees. If you're buying and selling frequently, those can add up.
So it's a balancing act, huh?
Exactly. And for someone over 40, it's essential to consider how much you're investing and how often you might need to access that money.
Yeah, and I think it's also about, risk tolerance.
For sure. As we get older, many people start to shift their focus from growth to preservation.
So it's not just about picking the best investment, it's also about understanding your personal situation.
Absolutely. And think about how someone might feel if they're nearing retirement and see a market downturn.
Oh man, that could be really stressful.
It can be. That's why having a solid strategy in place, whether it's through index funds or ETFs, can really help ease those worries.
I also think about the emotional side of investing.
Yes, investing isn't just numbers on a page. It's tied to our goals, our dreams.
Right, like saving for a grandchild's education or planning that dream vacation.
Exactly. And that's where these investment vehicles come in. They can help you align your financial strategy with your life goals.
So for someone over 40, do you think it's better to focus on one over the other?
Well, it really depends on individual circumstances. Some might prefer the simplicity of index funds, while others enjoy the flexibility of ETFs.
So it's not a one-size-fits-all situation, right?
Not at all. The key is to evaluate your financial situation, your goals, and your comfort level with each option.
And, I think it's also about staying informed.
Yes, the more you know, the more empowered you feel.
So for our listeners out there, if they're feeling a bit lost, what's a good first step?
I'd say start by assessing your current financial situation.
And maybe even talking to a financial advisor, right?
Absolutely. A good advisor can help you navigate these choices and find a strategy that works for you.
All right. So it sounds like understanding index funds and ETFs is really about making informed choices that align with our lives.
Exactly. And now that we've laid the groundwork, let's dive into some core strategies that can help you make the most of your investments.
So Alex, we're diving into this topic of index funds versus ETFs today, right?
Yeah, absolutely, Jordan. It's a great topic, especially for folks over 40 who are thinking about long-term wealth.
Right. So let's start with the basics. What's the main difference between an index fund and an ETF?
Well, the main difference is how you buy them. Index funds are typically bought through mutual fund companies, and they're priced at the end of the trading day, while ETFs, or exchange-traded funds, are bought and sold like stocks throughout the day.
Got it. So it's like you could just hop in and out of ETFs whenever you want?
Exactly. That can be a big advantage, but also it can be a double-edged sword,
That makes sense. So for someone just starting out, which one would you recommend?
Well, I'd say it really depends on your investment style. If you like the idea of a set-it-and-forget-it approach, index funds might be more your speed.
Right, and that's because they're usually more straightforward, right?
Yeah, exactly. With index funds, you invest a lump sum, and then you just let it grow, with lower fees compared to actively managed funds.
And what about ETFs? Are they more for the hands-on investor?
Pretty much. ETFs can be a great choice if you want flexibility. You can trade them anytime during market hours. Plus, they often have lower expense ratios compared to index funds.
Interesting. So if someone is more active and wants to manage their portfolio, ETFs could be the way to go?
Exactly, but there's also the trading fees to consider. Some brokerages offer commission-free ETFs now, which helps.
Yeah, definitely. So let's talk about diversification. How do these two options compare in that regard?
Good question. Both index funds and ETFs can provide broad market exposure, but it really depends on the fund itself.
Like, some ETFs might focus on specific sectors or themes, right?
Exactly. So if you're considering an ETF, you want to look at what it's tracking. An S&P 500 ETF gives you broad exposure, while a tech-focused ETF, well, it's narrower and can be riskier.
That's a really good point. So if someone is looking for a simple way to diversify, sticking with a broad index fund might be safer?
Yeah, that can be a solid strategy, especially as you approach retirement. You want to minimize risk, and broad index funds can help with that.
So what about the investment minimums? Are there differences there?
Yeah, there can be. Index funds often have minimum investment requirements, like $1,000 or more, while ETFs can be bought in single shares, which makes them more accessible.
So if someone has a smaller amount to invest, ETFs might be better initially?
That's right. But remember, it's important to think long-term. If you're investing in a way that adds up over time, those initial minimums can become less of a barrier.
For sure. And speaking of time, let's talk about the power of compounding. How do these investments contribute to that?
Great topic. Both index funds and ETFs benefit from compounding returns. The idea is you earn returns on your investment, and then those returns start earning returns too.
So it's like a snowball effect?
Exactly! The longer you leave your money invested, the more powerful compounding becomes. That's why starting early is so important, even if it's just a small amount.
Right. You mentioned fees earlier. How do they play into this whole equation?
Fees can eat into your returns over time, so you want to keep them as low as possible. Generally, ETFs have lower expense ratios compared to index funds, but it's essential to read the fine print.
Yeah, and some funds have hidden fees, right?
That's correct. Always look for things like sales loads or management fees. They can really add up, especially over decades of investing.
So what's a good rule of thumb for fees?
A good rule of thumb is to aim for an expense ratio below 0.5%. The lower, the better. But make sure you're also considering the fund's performance and what it's tracking.
That makes sense. And what about tax implications? Are there differences between index funds and ETFs there?
Yes, there are. ETFs are generally more tax efficient because of how they're structured. They allow you to avoid capital gains taxes until you sell.
Oh, interesting. So if someone's looking to minimize taxes, ETFs could have an edge.
Exactly. But it's always a good idea to consult with a tax advisor for personalized advice.
Absolutely. So let's summarize what we've talked about so far. For someone over 40, index funds offer simplicity and lower costs, while ETFs provide flexibility and potentially better tax efficiency.
You got it. And remember, it's important to assess your own risk tolerance and investment goals before diving in.
Right. And don't forget about diversification and keeping an eye on fees, too.
Yeah, those are key. And, avoid trying to time the market. It usually doesn't work out well.
So true. And that leads us to some common pitfalls that investors might encounter when choosing between index funds and ETFs.
Absolutely. It's easy to get caught up in the hype and forget the fundamentals.
Let's dive into that next. So Alex, let's dive into some common pitfalls when it comes to index funds and ETFs.
Absolutely, Jordan. One of the biggest mistakes I see people make is not really understanding the difference between index funds and ETFs.
Right. I mean, they sound similar, but they're not exactly the same, are they?
Exactly. So index funds are mutual funds that track a specific index, like the S&P 500, and they're typically bought at the end of the trading day, whereas ETFs, or exchange-traded funds, trade like stocks throughout the day.
Yeah, and I think that's where a lot of confusion comes in. People might think they can just buy either one without really knowing what they're getting into.
Exactly, and that can lead to some costly mistakes. For instance, I had a client who only looked at the expense ratios, the fees associated with each option.
Oh, that's a classic mistake.
Right? So he went for the lower cost ETF thinking he'd save money, but he didn't realize that he was trading in and out way too much, racking up commissions and ultimately losing more than he saved on the fees.
Wow, that's a real eye-opener. So it's not just about the expense ratio.
No, it's about understanding your own investment strategy and how often you plan to trade. If you're a buy and hold investor, index funds might be a better fit. But if you want flexibility, maybe ETFs are the way to go. Just be mindful of those trading costs.
Yeah, and I think another pitfall is not considering the tax implications.
Absolutely. A lot of people overlook that. For instance, with ETFs, because they're traded on an exchange, you can incur capital gains taxes every time you sell, whereas with index funds, you typically only pay taxes when you sell the fund itself.
Right. So it's like you could end up paying more taxes if you're not careful.
Exactly. And I had another client who bought an ETF thinking it was the smart choice. But when she sold it, she didn't account for those capital gains taxes, and it really hit her hard.
Ouch. That's a tough lesson to learn. So how can people avoid these pitfalls?
Well, first and foremost, do your homework. Understand the product you're investing in, read up on the differences, and don't just look at fees. Consider your investment strategy, your time horizon, and your tax situation.
That makes sense. And I think having a plan is crucial too, right?
Absolutely. Having a clear investment plan helps you stick to your strategy and not get swayed by market fluctuations.
Yeah, like when the market dips, some folks panic and sell, right?
Exactly. I mean, I've seen it happen. A client of mine sold all his investments during a market downturn, thinking he'd cut his losses. But the market rebounded, and he missed out on significant gains.
That's such a common reaction. It's understandable, but it can be so detrimental.
It really can. So recognizing those danger signs, like feeling overly anxious about your investments, can help you take a step back and maybe consult with a financial advisor.
Yeah, I think that's key. Having someone to guide you through those tough decisions.
Definitely. And another pitfall I see is chasing performance.
Oh yeah, like jumping into a popular fund just because it's been doing well recently.
Exactly. I had a client who saw an ETF that had skyrocketed last year and decided to invest a big chunk of her savings into it without doing any further research.
And how did that turn out?
Well, the ETF had a rough year after that, and she ended up losing a lot of money. If she had looked at its long-term performance and fundamentals, she might have made a different choice.
Yeah, it's so important to think long-term, isn't it?
It really is. Investing is a marathon, not a sprint. And, another mistake people make is not rebalancing their portfolios.
Oh, right. Like they just set it and forget it?
Exactly. Over time, certain investments may grow faster than others, skewing your original asset allocation. If you don't rebalance, you could end up with a lot more risk than you intended.
So how often should someone rebalance?
It really depends on your individual strategy, but I usually recommend reviewing your portfolio at least once a year. It's a good way to make sure you're still aligned with your goals.
Makes sense. And speaking of goals, I think having clear financial goals can really help avoid these pitfalls.
Absolutely. When you have specific goals, it's easier to choose the right investment vehicles and stay focused even when the market gets bumpy.
So what's the takeaway here, Alex?
Well, I'd say educate yourself, understand the differences between index funds and ETFs, know your investment style, be mindful of taxes, and don't let emotions drive your decisions.
It sounds like a solid plan. And for those who may have made mistakes in the past, it's never too late to learn and adjust, right?
Exactly. The important thing is to learn from those experiences and take proactive steps moving forward.
Great advice. So what's the next step for our listeners?
Start by reviewing your current investments and maybe consider setting up a meeting with a financial advisor to discuss your strategy in more detail.
Perfect. Thanks, Alex. I think this has been super helpful for anyone looking to navigate their investment journey.
My pleasure, Jordan. And remember, investing is a journey, and we're here to help you along the way.
So, Alex, we've talked a lot about index funds and ETFs today, but what can our listeners do right now? I mean, what are some immediate steps they can take?
Great question, Jordan. Starting small is key. It doesn't have to be overwhelming. First off, I'd say just get familiar with the basics. Read a few articles or watch some videos about index funds and ETFs. There are so many resources out there.
Yeah, totally. I've seen some great content online. What about apps or platforms? I feel like tech can really help people get started.
Absolutely. There are some user-friendly investment apps like Robinhood or Acorns, and even Fidelity's app. They can be great for beginners. You can start with a small amount, even just a few dollars.
Right, and I think Acorns even rounds up your purchases to invest the spare change, which is a cool way to get started without feeling the pinch,
Exactly. That's a great point. And then, once you've picked a platform, you can set up automatic contributions. Even if it's just $50 a month, it adds up over time.
Oh, for sure. That's the beauty of compounding. Speaking of which, are there any particular index funds or ETFs you'd recommend for beginners?
Well, it really depends on your goals. But some popular options include the S&P 500 index funds, like the Vanguard 500 index fund, or ETFs like SIPY or VOO. They're pretty straightforward, and historically, they've done well.
Yeah, I've heard about those. And I think it's important to remind our listeners to check the expense ratios, right?
Yes, that's a crucial step. Lower expense ratios mean more money stays in your pocket, so definitely pay attention to that.
Okay, so we've got apps, setting up automatic contributions, and picking funds. What else can they do today?
They could also create a budget if they haven't already. Understanding where your money goes each month can really help you find that extra cash to invest. There are great budgeting apps like Mint or YNAB, which make it a bit easier.
Right, and budgeting can feel a little daunting at first, but it's really just about tracking your expenses, right?
Yes, exactly. Just a simple checklist, like write down your fixed and variable expenses, and then see where you can cut back. It's all about prioritizing your goals.
So once they have their budget sorted, what should they do next?
Well, I think it's important to establish a habit of reviewing your investments regularly. Maybe like once a quarter? Just check how things are performing and adjust if needed. But don't obsess over daily fluctuations. That can be stressful.
Yeah, definitely. I mean, investing is really a long game, right?
For sure. And speaking of long-term thinking, I'd suggest reading some books on investing. The Intelligent Investor by Benjamin Graham is a classic. It's a bit dense, but it really teaches the principles of value investing.
Oh, I've heard about that one. And what's the other book? A Random Walk Down Wall Street?
Yes, that's another great read. It simplifies a lot of concepts and helps you understand market behavior.
Nice. So we've got apps, budgeting, reading materials. What about mindset?
Oh, that's so important, Jordan. Developing a long-term mindset is crucial. Remind yourself that investing isn't about getting rich quick. It's about building wealth over time.
Right. And staying disciplined. Like, not panicking when the market dips, you know?
Exactly. It's all about perspective. If you can remember that dips are just part of the journey, it'll help you stay the course.
So to recap, our listeners can start with budget apps, set up automatic contributions, choose a fund, and read some great books. Sounds manageable.
Absolutely. And don't forget to celebrate the small wins along the way. Every step counts.
Oh yes, that's so encouraging. And I love the idea of building those small habits. They really do add up, don't they?
They really do, Jordan. So just remember, it's not about how much you start with. It's about getting started and being consistent.
Well, that's a perfect note to wrap up on. Thanks so much, Alex, for all these actionable tips.
My pleasure, Jordan. I hope our listeners feel empowered to take those next steps.
Absolutely. And to our listeners, remember, you're not alone on this journey. Start small, build those habits, and keep learning.
Yes, you've got this.
We'll catch you next time on Prime Wealth. Take care, everyone. Well, Alex, I think we've really unpacked a lot today about index funds and ETFs, right?
Absolutely, Jordan. So to wrap things up, one key takeaway is that both index funds and ETFs are great options for long-term investing. They really can help you build wealth over time.
Yeah, and another point we discussed is the cost effectiveness of both. Low fees can really make a difference in your returns. It's like every little bit counts.
Right, and we also talked about the ease of access. ETFs can be traded throughout the day, which gives you flexibility, while index funds are often more straightforward for beginners to get into.
Exactly. And don't forget about diversification. Both options help spread out your risk, which is super important as you build your portfolio.
Definitely. So whatever you choose, just make sure it aligns with your financial goals and risk tolerance.
Yeah, and remember, investing is a journey. It's all about starting where you are and making progress over time.
Well said, Jordan. And if you found this episode helpful, please take a moment to like, subscribe, and comment your thoughts below.
And if you know someone over 40 who could use this info, share it with them. It's really important to have these conversations, right?
For sure. And next time, we're diving into something really exciting. How to start investing with just $100.
That's right. So whether you're just getting started or looking to refine your approach, we'll have some great tips for you.
Can't wait for that. Until then, take care and happy investing.
Bye, everyone. See you next time.